So we have a cyclical seasonal component, and then we have the structural secular outlook. And that's where the real growth is. The real growth is in the LNG side. And the other piece of the domestic equation is what you all have talked about for quite some time, the technology sector growth. And that is palpable and that is consistent and persistent, and that's much more visible, right? The LNG piece is much more of a longer tail.
We expect there to be some demand growth from the rollout of AI in Europe. It won't be nearly as accentuated as it will be in the US. So from that manner, we don't see a transformational sort of trend in terms of power demand. Power demand in Europe has roughly fallen 1% per year since 2008.
What I'll tell you is the more that you deploy, the more that you build out solar and wind infrastructure, the more you're going to need natural gas infrastructure, and natural gas storage.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On today's call, we've got Patricio Alvarez joining from his usual perch in Madrid, and then swinging across the pond, we've got Vince Piazza joining from an undisclosed location in the broader Northeast corridor. So let's spend some time with the two of you. We've got two of our gas experts on the call today. Well, there are many things more than that, but I want to do a little bit of a compare contrast on kind of how to think about the U.S. gas market and the European gas market as we head into the winter season. Vince, I'm just looking at your 2025 outlook, and you flagged three key items to watch. You flagged geopolitical uncertainty, M&A, and free cash flow yield. So give us a breakdown. How do you think about natural gas as a commodity, and how do you translate that into your outlook for the companies?
Yeah, hey, thanks, Rob. My undisclosed location is the sunny confines of Philadelphia, and with the Philadelphia Eagles now 10-2. That's all we really care about in the city of brotherly love. So let's take those in reverse order. So cash flow yields are definitely driving sentiment in my book. That will continue in 2025. I will say that the publicly held operators are very persistent in their view of controlling production growth, controlling the budget. The private operators are actually growing output. And I think this is pretty consistent with their view of trying to take market share, trying to grow their production in order to present themselves in a better light to potential acquirers. But still, in the month of November, we were roughly running about 2-3 BCF behind year ago period. So there is a consistent discipline that we see throughout the industry, really because of the public operators holding down the fort. Free cash flow yields are definitely in the upswing. And I think this is important because the balance sheets are in much better shape this year versus the prior cycles. So in terms of financial flexibility, the operators are in great shape. They do have the opportunity in 2025 to mix base dividend growth with growth in supplemental payouts. We would rather see that than buybacks. Last quarter, buybacks did tick up and surpassed dividends. I'm of the belief that it's the dividends that really provide confidence to the underlying shareholders and speak to the confidence of the business as opposed to the buybacks. On the geopolitical front, look, We are now an LNG juggernaut, and spot flows can move into Asia. Spot flows can move into Europe. A few years ago, when Russia first attacked Ukraine, there were some concerns about hydrocarbon safety. Our molecules flowed into Europe, and that helped Europe balance their market. U.S. natural gas is now part of a global gas business. And so the geopolitics present an interesting opportunity and a risk, but the molecules are there in the spot market. And it's one of the items for us. In terms of M&A, we saw the large M&A deal, Chesapeake and Southwestern, that created Expand Energy. That's now the largest independent natural gas operator in the U.S. in two key basins. And we think that that will likely spur additional M&A because we need that consolidation on that side of the fence as well. So hopefully we'll see more of that in 2025. And I think those are the three keys as we move into 2025 and even beyond.
Patricio, let's swing over to Europe. Give us your sense. I mean, how do you, hearing what Vince just said, how do you think about the European gas market in 2025?
Sure. So we've recently updated our numbers and our storage figures for this winter, which is the main driver, I think, for prices in 2025. Like Vince mentioned, Europe has pulled on mostly U.S. LNG to backfill the gap left by Russian pipe flows in 2022. But the big caveat there is that came paired with a 20% decline in gas demand. So European gas demand is still roughly 20% below what it was in 2021. And given that now the region relies on LNG much more than it did before, roughly 40% of our supply comes from LNG. That means that we are exposed to supply shocks and to price competition with Asia. And that's why the storage number is so important. We've seen inventory draws that have been the highest in over 10 years in November here in Europe, which means that we're perhaps running out of luck after 2 winters of milder than average temperatures. November was one of the coldest over the past decade or so. So now we've revised our storage figure by the end of March down to 39% versus 43% before. That's still relatively healthy, but there's a risk that if we see cold spells repeat or extend, that figure could drop below 28%, which means that the reinjection gap for next summer will be much bigger, roughly 20 billion cubic meters bigger for next summer. That also assumes that the residual flows from Russia running through Ukraine stop at year end with the end of a transit deal with Gazprom. So that kind of complicates the gas supply demand balance for Europe, we think, and that is reflected already in the futures curve. We've seen prices for summer trading almost flat versus the prices for this winter at roughly 46 to 48 euros per megawatt hour. That is more than twice what the average used to be before the war in Ukraine, and it's 15 to 20% higher what the average price will be in 2024. So from that standpoint, I'd say not great for the European consumer, especially when we see a stagnating economy overall in major economies here in Europe. But from the standpoint of utilities, given that we are mainly buyers, that's why we focus on utilities mainly with gas here in Europe. A lot of utilities still will be able to make or optimize their commodity trading desks to improve their profits from commodity trading here in Europe, and also gas storage arbitration should improve on the back of this of the spike in gas prices. The spike in gas prices is also driving higher power prices. Right now, we're seeing wholesale electricity prices that are the highest since the end of 2023, at over 100 euros per megawatt hour, which is almost twice again what power prices used to be. So it's sort of I would say a tailwind for power generators, a tailwind for energy retailers, and integrated utilities with retail sales will also perhaps gain on the back of this. So I would say broadly positive for European utilities, but a net negative, I would say, for European consumers.
Just curious, when you think about the balance, if the piped Russian flows via Ukraine really do finally come to a full halt, is most of that being made up with LNG demand destruction? Kind of how do you balance the market with the loss of those molecules?
So I would say demand destruction, I would say is kind of we were maxed out on that front, I think, and that's mainly because we've seen the cold start to the heating season really stoke up demand and consumption. And whilst there's other energy efficiency measures in place, I mean, you can see the result is that if we have cooler temperatures, we'll draw on gas because we just don't have any choice. And on the other hand, the other sort of lever to pull is LNG. There's really no supply upside or flexibility from other pipeline sources, so there's no more flows possible from Norway or Azerbaijan or the north of Africa. We're pretty much running at capacity from pipe flows, and that's because they tend to be cheaper than LNG. Those are tapped out, so really we would need to make up the difference with LNG. Russian flows via Ukraine are roughly 5% of European supply at the moment. They're roughly 15 billion cubic meters a year. So let's say it's not a massive gap to fill, but it would definitely tighten the market a little bit into next year.
Okay, Vince, I'm just looking at the screen real quick here. So, European natty gas is about $15 per MMBTU. Henry Hub's just over 3. What do you make of the LNG angle? Is that a key part of the sort of long-term exposure for the names that you think about here in the U.S.? Does that ultimately give you some price optimism when you look out over the next few years? Kind of how do you think about
Yeah, no,
this dynamic Pat was just describing?
yeah, absolutely. So we have a cyclical seasonal component, and then we have the structural secular outlook. And that's where the real growth is. The real growth is in the LNG side. And the other piece of the domestic equation is what you all have talked about for quite some time, the technology sector growth. And that is palpable and that is consistent and persistent, and that's much more visible, right? The LNG piece is much more of a longer tail, but it is a major piece for the balancing items that we see over the long term. The technology piece, even you guys have said, it's a broad range, right? And that really affects the natural gas component domestically, share of natural gas in the power stack, whether that's on site for an AI company, or it's via general transmission by the utility. But that is a definite growth catalyst. The LNG piece, you could see LNG doubling over the next decade, along with demand from the AI side of the house. And those are definite growth drivers. Pushing molecules out to Europe, that is extremely important to helping balance the market more longer term. And that's why you saw basically the deals that we've seen in the Haynesville, which is quite near key LNG export hubs. Expand Energy did the deal that they did to gain scale for that very reason. All molecules are coming to the Gulf Coast in order to take advantage of LNG seaborne flows. There is smaller flows coming out of the East Coast, but almost all of it is centered around the hubs around the Gulf Coast. And that is a key piece to the pie. And that may actually overtake natural gas feedstock into the power generation sector, quite frankly. So that definitely is the key for growth for this legacy natural gas, which and we've said this in the past, if you had to pick nat gas versus oil, where would you rather be? And, I'm talking my book here, but I see the longer term picture for natural gas as opposed to oil, because quite frankly, you can electrify everything, but you still need to power it some way. You still need to attach it to the grid, and natural gas would be around longer than my kids will. So.
I love your thesis there, Vince. So I got two questions for you as a follow-up. So the first one is, when you think about the gas value chain, you could potentially be in the E&P names, or you could be in more LNG specific names.
Yeah.
How do you think about that dichotomy? Is there a better place to be? Which one's going to generate better cash flow or returns over the
So,
next few years in your mind?
So I think that when you think about the longer tail nature of building LNG facilities versus the manufacturing process of extracting the molecule, personally, I'd rather be extracting the molecule because it's a shorter cycle play, as opposed to dealing with these longer cycle capital equipment investment, waiting for the permit. Uh, to me, the molecule itself and how it's extracted is much more interesting from a return on investment perspective. We've said in the past how important it is to recycle those dollars, the netbacks and the free cash flow that one can generate. And I think that still is the case. So again, talking my book here, covering the upstream side of the house, I'm much more interested in the dynamics of what E&P 2.0 looks like. And we said this in the past in our deep dive, that we foresee a scenario, a landscape where you have fewer natural gas producers, but much larger natural gas producers controlling bigger shares of the market, controlling the pace of output, but also controlling larger balance sheets with greater financial flexibility and the opportunity set to pay out dividends and also return excess cash to investors, in managing the shareholder engagement process much more profoundly.
Very interesting, Vince. Okay, so the other question that kind of came to my mind as you were talking about your thesis on gas, and this probably alludes to a little bit where I'm at on the topic, but how do you think about the competition between gas and renewables? I've always thought of them as sort of frenemies. They're sort of the thesis that you outlined of electrification bodes well for wind and solar. I think it also bodes well for gas.
Yeah.
So but I do think perhaps on the margin, maybe there is some competition, but how do you see them as sort of complementary, or are they opposed?
Well, it depends on, which part of the country and who you talk to in those parts of the country, right? Because for renewables and alternative sources versus legacy oil and gas, there's always a civic, political element to this battle, right? Legacy molecules, bad; solar, wind, great. But what I'll tell you is, the more that you deploy, the more that you build out solar and wind infrastructure, the more you're going to need natural gas infrastructure, and natural gas storage because of the latency issue. It's intermittent. Not every place can be Florida or Arizona and Nevada, where there is ample sunlight. Not every place can be as windy as the Midwestern parts of the country. So those sources are intermittent, and you need some type of alternative to those intermittent sources as a backstop, or more importantly, as your main draw to provide the feedstock into the power gen. Obviously, this administration, this incoming administration, is more likely more friendly to legacy sources. But I think if you were to remove the politics, you would see that all three sources are indeed needed as we move through this period of unprecedented structural growth and structural need for generation, both legacy generation and solar and wind, because of the call from the tech sector, which will be extraordinary and will be growing rapidly, and also from the call of feeding the world our very economic molecules.
Very interesting. So, Patricio, I want to come over to you and ask a very similar question. How do you think about that, the dynamics of competition between renewables and gas? And I'm going to sort of plant an interesting nugget here as well. Very fascinating piece from Bloomberg News 2 days ago, that the title of the piece is UK is paying £1 billion to waste a record amount of wind energy. And it's basically about the curtailment of wind farms in Scotland. So very interesting read. I highly recommend folks go check that out. But what does that tell us about some of the dynamics over in Europe, and sort of also how do you think about this question generally of competition between gas versus wind and solar?
Sure. Sure. I think that on the first question, I think it's important to give a bit of context on what the expected increase in power demand from data centers is in Europe relative to what it's expected to do in the US. While we expect there to be some demand growth from the rollout of AI in Europe, it won't be nearly as accentuated as it will be in the US. So from that manner, we don't see a transformational sort of trend in terms of power demand. Power demand in Europe has roughly fallen 1% per year since 2008, and we don't expect AI to inflect that general trajectory. But that said, that incremental demand will help offset other declines. And where does renewable power fit in that puzzle is that, well, I think it's just the economics make wind and solar sort of the best placed to meet that incremental demand to that threshold where they can. They are intermittent, so we will need to find another dispatchable source to cope with that intermittency. Natural gas could be one of the sources. Hopefully, also battery storage will be important as well. And I think the case for gas in Europe is not as strong as it is in the US, mainly because Europe is a net importer of gas. Our production reserves are declining. And that's why one of the reasons why European gas prices are nearly 4 times what they are in the US. So from that perspective, I don't think the case for gas is strong. And on top of that, you have carbon allowances in Europe, which make it even more expensive to burn gas or coal for dispatchable power. So that's kind of the mix. We don't think there's much potential for nuclear energy, just because it takes a while. It takes over 10 years to build a conventional plant. So perhaps nuclear could play a role, but not in this decade. And I think, yeah, I think that's how we pit wind and solar. And then on the second part of your question on curtailments, I think what it brings up is the need for grids. I think that's really what the pain point is, at least in the UK example. Is what happens is where you have really strong wind resources in Scotland. Those are not interconnected to the south of England. So that means that when you have excess wind resources and there's no demand in Scotland, you need to pay producers or wind operators to curtail that power and pay for that power even though you're not going to use it. And then in the south of England, gas-fired plants are being fired up to meet that excess demand. So there is a problem there that needs fixing, and I think that kind of just highlights the need to invest in grids. I would say if I were to characterize or describe in which part of the energy transition we are, I would say the U.S. is still in this expansionary phase of secular demand growth, and you're trying to meet that with all the generation capacity, like Vince mentioned. This is a problem of capacity of power generation. I think in Europe it's more of a problem, like we have already deployed a lot of renewables. Our power prices are coming down because of that. We don't have that demand tailwind. So now we're in the period of entering of how do we optimize the resources that we have, and that is either via storage and also the improvement and expansion of power grids.
Fantastic. Okay, I know Vince has to run in 3 minutes. Let me do a quick advertising bit. So we are holding these calls 2 more weeks this year through the 18th. Then we'll take a couple of weeks off because of the holidays, and we'll reconvene January 8th. And then I'll just highlight, we'd love to see you all in person. So I know for sure Vince and I are both going to be at our big event in Indianapolis in early April. So that's our Farm, Food, and Fuel Summit. Big 2-day event. Lots of great stuff coming together for that. Many of our other colleagues will be there, but if you fancy coming to Indianapolis in early April, just reach out. We'll get you the details on that. And I think it's also likely we're going to host an in-person event in late February in Miami. So stay tuned for that. We'll get the details out shortly. But Vince, 2 minutes before you run, we didn't get to spend any time on your outlook for the oil side of the equation. Yeah. So I know you've got that outlook out as well, just a week or so ago here. So give us a rundown on oil real quick.
Yeah, so similar dynamics 2024 in terms of controlled production growth, capital discipline, pushing free cash flow to provide financial flexibility for these operators. The great unknown is obviously OPEC plus and in general the geopolitics of both what's going on in Europe and also in the Middle East. What I would also point out on the topic of natural gas and what we recently put out, focus idea for winter. Come to us if you want to get a flavor for that. And also we have a note out on storage needs in the U.S., considering the new dynamic of this build out in AI and how that impacts U.S. natural gas storage needs as well. So yeah, we have both outlooks out. That was last week. We have our focus idea for natural gas winter and also our storage piece as well. So hit us up, and I guess we'll see you guys next week from sunny Philadelphia.
All right, take care, Vince. And Patricio, we'll give you a couple more minutes here before we run. One thing I wanted to just quickly touch on your franchise is you launched on a new company just here the other week, Anji, and give us a sense how do you think about that company, and how does some of the themes, particularly around gas, play into your thinking on that name?
Okay, sure. Yeah, the first part, Engie is one of the largest gas-fired operators in France and in Europe. It's a juggernaut in terms of gas trading and commodity trading. It has assets in over 20 countries, most of them gas-fired. It also, the company also operates most of the French networks in terms of gas. So it's a very gassy utility, I would say. And that meant that during 2022 and 2023, during the energy crunch here in Europe, the company really beefed up its earnings. It really rapidly delevered the balance sheet. And I think now the company, overall, our thesis is that it's doing the right things to try and address its valuation discount to other diversified majors. So we're talking about Iberdrola and Enel, which are sort of the other two main competitors or more comparable companies here in Europe. So Engie is really investing hard into renewables. Why does Engie want to do that? Because renewables tend to be long-term contracted. So over time, that should improve the earnings quality, the earnings stability, predictability, whatever you want to call it. It will improve the recurring earnings profile of Engie and perhaps ultimately help narrow that gap to peers. Now, in terms of the second part you just mentioned, gas prices have been rebounding hard since November. And now we think they're going to be up 15 to 20% in 2025. And if you think that Engie's division of commodity trading division, those earnings were going to fall by roughly 30%. And now we're seeing this increase in gas prices of almost 20%. I think consensus has not adjusted for those changes. So there's scope for Engie to actually sustain those record earnings that it had in 2023 and 2024, because 2024 will almost be comparable to 2023 in terms of earnings. So if anything, Engie could benefit from this tightening of the gas market. And I think strategically, the company, longer term, I think is taking the right approach in trying to reduce exposure to price volatility.
Thanks, Patricio. Just several questions coming in from the chat. One of them is about the mandatory storage requirements in Europe, and another is about LNG. So just give you a quick opportunity to address either one of those before we close out here. Sorry, Pat, you're on mute.
So the first, the question on storage, I think it's something that we talked about recently. So the EU did not lower its storage target for February. I mean, it increased it from 45 to 50. So before they wanted storage at the end of February to be 45% full. Now they've increased it to 50% full. Our latest numbers, because we got this question from a reporter as well. Our latest number actually landed. That figure in February was 45% in our scenario. So what that means, if you increased it to 50%, that means that we need to start pulling higher, pulling harder, or pulling more on LNG. And that's what's been going on. If you look at why prices are increasing towards that 50 euro threshold, it's because we are now at periods in November, at least, we outpriced, outcompeted Asia for LNG. So prices in Europe, gas prices in Europe, were higher than they were in Japan, Korea, for the Japan-Korea marker. So that means that perhaps the ceiling is 50, but we are responding to that change. To that change in the target, so we are pulling more on LNG. I think that's kind of the question, right? Like demand is increasing, and if we want to hit that target, we just need to import more LNG, and it's gonna cost us more, which is reflected in the price.
All right, fantastic. For everyone who's still with us, I'll just one last bit of advertising. I mentioned the events. Another thing is that Patricio and I are in the process of launching a new client chat for anyone that's interested. That's going to be a little bit more clean energy transition focused. So we have this. Many of you are already participants in the BI Energy Exchange chat, which is great, very active, tends to be very often very oil focused, traditional fuels focused. So for anyone who also wants a little bit more focused chat to think about wind, solar, how gas fits in the equation, this kind of thing, we are going to be launching that. I would assume that many of you might actually be interested in both. So if you're not in the current chat, let us know. We're happy to get you added. And if you want to be in the new chat, reach out to Patricio or myself, and we'll get you included. And again, we do these calls every Wednesday at 10 a.m. New York, 3 p.m. London. Please join us, spread the word with your colleagues. We're happy to have anyone within the sort of wider Bloomberg family join us. So until next week, I hope everyone has a great remainder of their week, and we look forward to seeing you next Wednesday. Take care. Bye, everyone.
Thanks. Bye.